What's going on, guys? Justice Roberts here with Renown Mortgage. I am giving you a presentation today regarding temporary interest rate buy downs, and I want to explain those in the best way that I can with some education. I want to teach a little bit. I want to help you understand what it looks like to understand, number one, how it works, but then also understand why that matters or why it may be a good strategy. And I want to teach you to think. I want to teach you to think about your situation, your financial situation. I want you to think about your career. I want you to think about your family. I want you to think about the market. I want you to think about economics. And I want to give you some good things to think about here today. So without further ado, let's dive in. So problem, opportunity, strategy. Every problem, there is always an opportunity, and we're going to talk about some strategies today. Okay, so problem is interest rates have increased and housing prices have virtually remained stable, or they have appreciated depending on your market, depending on where things are sitting. And this has caused a huge gap of affordability and a challenge for so many individuals. So the opportunity is that you as a home buyer can get into a home with much less competition, resulting in less money out of pocket from a standpoint. And what we're going to really talk today is about a strategy of how we can have sellers help you get into a house in a way that makes sense for you, and not just makes sense for you, in the short term, but can actually be a win for you long term. Here's the strategy to making a home way more affordable in this current interest rate environment. So you can buy a house that makes sense right now. Who is this for? Who is this not for? Think about it like this. As a primary residence and you're purchasing, that works for you if you're doing a traditional mortgage. So this could be a first-time home buyer, could be a move-up home buyer, could be something with a vacation home purchase, or purchasing anything with a conventional loan. Who this is not for, it's not for investors. This is not for jumbo loans or non-traditional loans. It's not for refinances. It's not for second mortgages and HELOCs. But it is for you as a first-time home buyer or you as a move-up home buyer, as long as you're purchasing a primary residence. Okay. Our philosophy is what drives our advice. Again, I want you to understand how we get to the place of thinking that this may be a good strategy. So I'm going to teach you how to think here. Here's some history of the Fed, and ultimately the Fed has a lot of control as it relates to the Fed funds rate, and the Fed funds rate influences mortgage interest rates. So I want to give you some context here. So we have a few different Fed chairs. Burns and Volcker, they had inflation that happened 7% to 14%. So they had a 7% increase. Mortgage interest rates, what happened with mortgage rates? Interest rates went from 12% to 18%. So I had 6% increase in mortgage rates. The Fed funds rate, Burns and Volcker, increased it from 11% to 20%, steep increase. Here's what happened after that. Inflation responded by moving from 18% down to 12%. What happened to mortgage rates when the Fed funds rate was increased or inflation came down? Mortgage rates respond 18%. They drop down to 12%. Here was the consequences, though. And I want you to understand from a recession standpoint what actually happened. The S&P was down 30%. There was a massive recession during this case. We don't know what's going to happen in our current timeline. I would say that we don't see things currently on a trajectory to have a massive, massive crash. But it's important to understand worst case scenario. If this happens, what then? How is the market going to respond? And what does history tell us? Greenspan, I'm going to go back and give another example. Inflation was at 1.75%. It increased to 3.5%, a little bit more moderate than Burns and Volcker. Mortgage interest rates went up about 1.5%. The Fed funds rate increased from 4.75 to 6.5%. So the Fed said, hey, we're going to step in. We're going to increase rates. What happened to inflation? Inflation went from 3.5% to 1%. So this stuff actually works. We're actually seeing inflation come down. What happened to mortgage rates when that happened? They went from 8.5% at the high to 5.5%. So we saw those go down. What were the consequences? The S&P went down 50%. There was a recession in that specific case. Now we come to our current Fed chair, Jerome Powell. Inflation at the low was 1.5%, and at the high eclipsed 9%. What happened to mortgage rates? We saw the low end 2.5%. They went up to 8%. 0% to 5.25% is what the Fed rate increase happened over the course of about a year. They went from 0% all the way to 5.25%. The inflation response, we topped out about 9%. And we're in the process to see how low it's going to go. I will tell you right now, we're just a little bit under 3% is where things are trending right now. And the goal of where the Fed wants to see before they are finished or satisfied is to have inflation reach 2% or greater. I'll get to that in a little bit more on the Fed here in a second. But mortgage rate response. We peaked out at about 8%. How low will it come down? Today, as I'm sitting here in the middle of July of 2024, mortgage rates currently are a little bit under 7%. So we're high 6-ish range is where things we're at. And the consequences, we don't know. Again, like I was saying, worst case scenario, we want to think through, hey, what's going to happen? I would say the current feeling of the market is that we're going to have a little bit more of a softer landing than was maybe anticipated, but that still remains to be seen. If we reach a recession, we probably won't know until after we've been in a recession. Just doesn't get measured. But I want you to see the patterns here. Number one, inflation rises, mortgage rates increase, Fed increases the Fed funds rate, then inflation drops, then mortgage rates follow. Recession, that's what we still are not entirely sure how things are going to play out. But these are some things to watch what happens in the past. So now let's take a look at a couple of different things. Number one, mortgage rates have come down in the last 6 recessions. So worst case scenario, if we're talking about recessions, what happens to interest rates in recessions? As we can see, each time 16% to 11.75, 18% to 13%, 11 to 8.75, 7.375 to 6.75, 6% to 4.875. When you show smaller recessions for shorter periods of time, we also show that there is a little bit less of a drastic change there. Now, what happens to home prices during recessions? Let's just bring it all out here. In all cases, except after the 2008, we saw home prices increase in every one of the recessions. And I'm going to get to a little bit on why that is here in a second. So what happens to housing in recessions? Typically, interest rates go down, housing becomes more affordable, then more buyers enter the market, then there's more demand, there's more people that want it than there is a supply of how many homes are there, then prices stabilize and accelerate. What's very interesting with our current market is the fact that home prices have remained pretty stable through that, which some is because of inflation, but I would say most of it has to do with the supply. The fact is there's not enough inventory based off of the people that are in the market, that there's been an abundance, even though there hasn't been as much supply, there's an overabundance of demand that's still present in the market, which is allowed home prices to increase in some areas and worst case flatline and kind of, over the last, look at the last 12 months, home prices, have not dropped. So what will happen if interest rates drop in our current environment? I just want you to think about that for a second. What will happen if interest rates drop in our environment? Prices are going to accelerate. Prices are going to go up. They're estimating over 1 million people every 0.25% drop from a national standpoint. So it's not going to be in your market specifically, but think about it from a national standpoint. If interest rates drop a full percent, and that's 4 million people that come into the market, that's going to pressure home prices up. Why is that a good thing? We're going to talk about that. A solution is a temporary rate buy down. So here's what a temporary rate buy down is. It's the seller paying the difference of the market rate and the buy down rate. it's your payment plus the seller payment equals the total payment. So roughly, if a total payment was $3,000 and the seller paid $700, you're going to pay $2,300. I'll get into that in just a little bit. You have three different options with a temporary rate buy down. There is a 3-year option, a 2-year option, and a 1-year option. Most common is the 2-year option for clients that I've been able to help. What that does is basically for a set period of time, you are taking, let's just say the market rate is at 7%. We're doing a 2-1 buy down. So 2% lower the very first year. That means what you're paying is 5%. The seller is going to pay 2%. You're going to pay 5% for the full first year. The second year, it's going to be 1% lower for you because the seller is going to pay that, and you'll pay 6%, and the seller will pay 1%. And then the year after that, you're basically taking over the loan. So here's a scenario. You have a $500,000 loan, assuming a market rate of 7%, using a 3-2-1 buy down. So the total principal and interest payment is $33.26. So here's what you pay. Year number one, you're going to pay $23.87 for the first year, and $26.84 for the second year, and $29.97 for the third year. And year 4, you're going to pay that full $33.26. Seller is basically, if you think about it like a seesaw, they're going to start off paying more per month, which is $939 per month. Second year is $642 per month, and third year is $329 per month, which totals, here's how we set these up. We total the amount for year 1, year 2, and year 3 together to create the total seller subsidy. Okay. Here's how your account works. So we negotiate that total amount, that $22,920. So at the end of year 1, your balance starts to get drained from that seller. So you only have about $11,652 in that account. And at the end of year 3, you got nothing. Here's the great part. If you refinance at any point in this process, it's a direct principal reduction on the loan, which means at the end of the day, if you buy a house today or tomorrow and interest rates drop a month from now, guess what? If you want to refinance after you've made 6 payments, you basically can take that full balance that you got from the seller, drop it on the balance of your home, which is you getting a better deal on the house, and your loan drops, and you're able to take advantage of what the current market interest rate is. Okay, here's a real life example. We had a family with 3 kids. They needed more space for their family, and their income increased over the last 7 years. So they found their dream home for about $800,000, $805,000. We negotiated $24,000 to go towards a 2-1 buy down and other closing costs, because the total buy down subsidy only cost $14,000, almost $15,000. They saved $810 per month for the first year, and $413 a month for the second year. Completion, guess what? Life moved on, and they aren't worried about their payment, and we're going to proactively monitor their mortgage, monitor the market, and we're going to help them get into the right long-term loan when we're positioned. Okay, so here's why I really like this strategy. Number one, it's the most impactful way to move the needle on your monthly payment. Let me say that again. It's the most impactful way to move the needle on your monthly payment. There are permanent rate buy downs, which we could cover in a different video. There are applying extra money for the down payment, or reducing the sales price, asking for a concession in that way. Or there's this specific strategy, which moves the needle 10 times fold what you could with some of these other strategies. Number 2, you never lose the money that you negotiate from the seller. If you were going to take it off the purchase price, guess what? It's the same thing as if you negotiate a seller credit to apply to a subsidy like this, and essentially it's still your money. We're just applying it, and instead of getting it in that way, we're going to do it in a way that addresses the most important problem, which is affordability and getting your payment more in line. Number 3, you can refinance into a long-term loan anytime. Number 4, you can take advantage of all the benefits of negotiation now. All the benefits of negotiation, whether it's being able to do a contingent offer. Maybe it's, time to do an inspection. You have an appraisal contingency, all of the things that make it so you can buy a house and have it on your terms. You have more advantage now than you will in a market where there's a lot more competition. Number 5 is home appreciation upside when demand increases. Think about what's going to happen when interest rates come down. Home prices are going to go up. If you already own a house, you are able to take advantage of where the market rate is as rates come down. However, you don't have to compete with any other buyers, and you get to be sitting on your couch enjoying watching your home value go up when you're refinancing, not having the competition. So that's why I like this strategy. Please contact me if you want to learn more. If you have any questions in regards to real estate, mortgage, rate buy downs, strategies for you to purchase a home, refinance a home, you want to invest, you want to look at fix and flip. I'm the founder of Renowned Mortgage, Justice Roberts, signing out. Take care, y'all. All right. We'll see you on the next one.